With interest rates low for quite some time, investors are chasing yield in many previously unfamiliar places, like the insurance and reinsurance markets. Here to discuss the effect all this capital is having on the industry is Dr. Robert Hartwig. He is president of the Insurance Information Institute and joins us from his office in New York. Dr. Hartwig, welcome back to the program.
Glad to be here.
So Bob, a recent III report suggests the world is awash in capital. Just where is all this capital coming from and how is it making its way into the insurance industry?
In our recent report on alternative capital in the global insurance and reinsurance business, we back up a step and we look at cash holdings by corporations worldwide. And as it turns out, the world is awash or flush with capital. We're talking about not just in the world of insurance, but we're talking about the worlds of technology, manufacturing, and many other industries. And so the question is how is all this capital going to be put to work? And when we look at areas such as pension funds and hedge funds, what we're seeing is that cash is really hot money and it's making its way around the world into all forms of alternative investments, moving far beyond traditional stocks and bonds that these large institutional investors have often held. And one area that they've discovered is reinsurance, in particular reinsurance catastrophe coverage, particularly areas such as catastrophe bonds. And some of that capital, a small proportion of it, has wound up in the global property catastrophe reinsurance business.
So reinsurance rates are suppressed. How does that affect the price of insurance?
Right. So as a result of this global transfer of capital into the global insurance and reinsurance markets, we have seen some reduction in the price of reinsurance. The rate on line has been falling, not only because of that, but because of good earnings that have pushed up retained earnings, and that has pushed up capacity as well, and also because of low catastrophe losses or nominal catastrophe losses in most parts of the year. When you put these three factors together, we've seen pressure on reinsurance rates, particularly catastrophe reinsurance rates on a global scale, and that has continued through 2015.
Let's assume interest rates start to climb. Could we see a reversal of the current trend in alternative markets?
There are several reasons to believe that the inflow of alternative capital into reinsurance markets could at a minimum be arrested. And one of those would be the return of higher interest rates. Again, it is low yields. The Federal Reserve's policy, the European Central Bank policy, the Bank of Japan policy that has driven all of these alternative investments to seek higher yields elsewhere. And one of those areas has been the area of reinsurance, particularly property catastrophe reinsurance. So it's certainly the case as the U.S. Federal Reserve Bank begins to normalize interest rates, and there's much discussion about that happening in the second half of 2015, that they at least begin that process. At least in theory, that would make additional investments in property catastrophe reinsurance somewhat less attractive.
What else might impact the availability of alternative capital?
Well, it's certainly the case that the rapid growth we've seen in alternative capital happens to have coincided during a period when there was relatively nominal catastrophe loss on a global scale. So it's certainly going to be the case that when non-traditional investors in this business find out that you can lose money, in other words, lose your principal on a catastrophe bond, for example, and that you could lose it on multiple bonds, and that you could lose it in multiple years in a row, then that may also do something to the appetite for these types of instruments. Again, so they've the massive inflows that we've seen post-financial crisis have occurred during a period of relatively nominal catastrophe activity. We all know that that can't be sustained forever.
We're curious about your answer to the last question in your report. Do you think the reinsurance industry has been fundamentally and irrevocably transformed?
I think it's too soon to really suggest that the reinsurance industry on a global scale has been fundamentally and irrevocably changed. It's certainly the case that alternative investors and pension and hedge funds have discovered as an asset class catastrophe bonds and similar instruments. They find them attractive for a variety of reasons. Even before the financial crisis, they were attractive because of the fact that property catastrophe risk is uncorrelated with traditional financial risk. So that makes them an asset class that can reduce volatility in a well-diversified portfolio, and it will remain attractive for that reason. However, I do think we need to go through a cycle in terms of pricing, and we've seen the yields on these alternative investments begin to drop. That's another reason that could make them less attractive. And also a period of heavy catastrophe losses, which will demonstrate to these investors that, in fact, losses can be sustained.
In part 2 of my conversation with Dr. Bob Hartwig, he discusses trends in the primary insurance market, including rising flood and hurricane exposures and emerging risk, including cyber and drone cover. So keep it here for more world risk and insurance news on RIN TV.